This is a briefing podcast, and today we're going to be talking about the great filter that has happened to a SPAC market. It's a redemption as well as the rule that has been introduced by the SEC. I'm Kanat Manjanov, and the mission of this podcast is to try and map how capital, technology, and geopolitics shape the industries. And the format is going to be one mechanism, one bottleneck, and three potential scenarios for that particular topic. The SPAC is a special purpose acquisition company. It raises the capital via the IPO with one particular reason, is to find a suitable target, a privately owned company, and merge with that company. And as the result, bring it to capital markets. And 21 was a tremendous year for capital markets. We bought flying cars, we bought pre-revenue companies, everyone were hallucinating. And that was predominantly funded by 0% interest rates. So the number of SPACs that were chasing the dream, chasing one particular target, was over 600. And from 21 until 2024, the market collapsed by 90%. And one of the key filters that I mentioned in the beginning is in relation to redemption. So the redemption has happened. Previously, everyone had their own SPAC before, but when the redemptions has started to appear, it means that an investor of a SPAC has an option, has a right to redeem their shares, in other words, take their money back. And that number reached to 99.6%, which means that all of the funds are gone predominantly by the time that a company or a target, as well as the SPAC, completes its merger. So there is no certainty in terms of the capital. And the SEC introduced a new rule in 2024, the Rule 33-11265, that shifts the liability to CEOs, the board, and underwriters of a target company. And that is very similar to a traditional IPO alike, which wasn't the case previously. So that has shifted completely the industry. So many participants that were involved, many underwriters that previously were in the space were gone. So that is the great filter. So if there is uncertainty of the capital, so no one can rely on a trust nowadays because almost 100% of the capital is gone. How do you fund? So today, more than 140 companies are looking for a target. How do you fund the deal? Is actually going and raise the PIPE. PIPE is a private investment in public equity. That is a private capital that you need to secure before completing a merger. And in any transaction nowadays, you need to have one in order to complete successfully, because otherwise you will have the fees that you're going to be piling, but you will not be able to complete the deal. And of course, for a target, is to have certain certainty that there is a minimum cash condition in place. And that's where the PIPE came in. So why would any potential target, or why would any CEO of a suitable target actually merge with a SPAC? And that is certainty premium. SPACs, they completed the IPO. That is stage one. The stage two, it's M&A transaction. It means that negotiate the valuation, negotiate the terms in order to complete the de-SPAC or consummate the business. And this is something that for many companies is priceless, is to have a certainty while if you are comparing to traditional IPO, you could be a victim of volatility of the market, or something will change that the window will close. And for that reason, you will not be able to complete your IPO. Whereas with a SPAC, there is a certainty. And in today's environment, when everything can shift, that is absolutely a no-brainer for many target, a suitable target. So what has changed? One of the things that has changed since 21, previously, any app developer with a great business plan, of course, there has to be some work to be done. But in any case, I'm exaggerating here. But to have a presentation and to promise that they will start generating revenues of hundreds of millions could catch a valuation over $1 billion. And today the investors looking after what was happening before, and many of the deals were done at a hype in terms of it was done at a time when the valuations were incredibly high. And of course, one of the key differences with a traditional IPO, SPAC previously allowed to have a forecast, a financial forecast, a prediction into the future that it will be able to generate X amount of capital. Whereas with a traditional IPO, you go into historical numbers. You will not going to be disclosing any future potential financials or revenues that you foresee that's going to be generating in the business. So that was the biggest differences that were misused by many market participants, whereas not the case anymore because of the rule that has been introduced by the SEC. So the asset class itself shifted tremendously. And you've probably seen the headlines by 24 that everybody were calling, or many people were calling, that the asset class, the SPAC itself is dead. Today is February 26, and the heart is beating, and is actually accelerating tremendously because there has been a shift towards the companies that going public. So the investor realized, and the whole market realized, that you cannot print the energy, and you cannot code the supply chain. Nowadays, the sovereignty of any nation, not only in terms of the border and how you can protect it, but most importantly, whether you have security, whether you have the critical minerals in order to secure, building the semiconductors or building the EVs, etc. So critical minerals, as well as the AI data centers, require energy. And that is where there has been a successful stories in a SPAC or de-SPAC transaction, in particular in defense, in nuclear, and critical minerals that has been trading over $10, and many successful deals that were able not only to raise the capital, but also to have a less redemption rates in comparison to everything else. So I think that is the biggest probably outcome of the great filter, as well as how the market or how the asset class shifted, how this asset class can be used in greater good, and for what particular companies in terms of the industry, in terms of the investors' appetite. And now we're going to be mapping the three potential scenarios for this industry, for a SPAC. So number one is that the SPAC itself is going to become boring, which is great. It will stabilize, there will be lesser redemption, and it will be focused only in hard tech or real industries, whether it's going to be nuclear, defense, critical minerals. The second scenario is going to be in relation to a pipe. So it's going to be that there will be private capital, sorry, not a pipe, but there will be more private capital. And the private companies will decide and will pay a premium to stay private longer. The scenario C is going to be that the SPAC will shift itself to more of a geopolitical tool that will be in relation to national security, that is going to be focused predominantly on a key industries like critical minerals in allied countries where the assets are located. And this hypothesis or scenarios are good only if you can prove otherwise. So one of the key points to look that I'm going to be looking or paying key attention to is the redemption rate. If the redemption will fall below 70%, that will mean that more new participants will enter the market, and it will break the great filter. The scenario B, or not scenario B, but scenario that is going to be affecting the scenario B is actually the lack of the pipe. So if there will be lack of pipe, then of course it will not be able to conduct the business combination. And the third that I'm going to be paying a key attention to is aggressive litigation by the SEC for any CEOs, because that will shift completely the decision making from the potential target. If there will be an acceleration in litigation, then of course any suitable target will decide or will try to weigh the pros and cons very carefully before going public. Thank you. Until the next one.